Hello, my name is True Demon, and I'm the Devil Stockbroker. Thank you so much for tuning in to watch this video. Before we begin, please understand I'm not a financial advisor, and none of the following content is financial advice. The following content is for educational and entertainment purposes only. Trading stock carries inherent risk, and you should always respect and understand your own personal risks when considering any investment. Please don't take what I say as gospel, and please do not trade based on the information that I receive and share through my content. Thank you so much, and have a hell of a time in the stock market. Hello everybody, this is True Demon, the Devil Stockbroker, and this is going to be a short technical analysis update, as well as I want to take the time to describe to you how to spot when a market maker is over leveraged on a particular stock, how I identify these squeeze plays, and what retail can do to take advantage. So here in front of me is a historic play, MULN. We're going to look at this one as well as a few others. There are consistent items and data that you can look to in order to pick out these plays, and it doesn't just have to be me that finds them. So the reason why I'm looking at MULN first is because MULN is one of the plays that I found in recent memory that you can still look at the stock on its historic options and its historic time in sales and price action. So this is very similar to AMC, SPRT, BBIG back in 2021, but this is the most recent one that was such a huge success. And then we'll go over a couple of other ones that are still going right now and why I think MULN and these other plays can make huge moves again. So in the beginning, before this occurred in MULN, this first big swing up, MULN was trading throughout February with some very, very severe downward price action. But during this time period, the volume in MULN was extremely anomalous. What do I mean by that is that before MULN had almost no volume. And after their earnings call, there was a little bit more volume, but it kept reducing in price. But what was interesting was how the OBV played out. So what was interesting was that we were seeing more buying volume in single spike candles, but the price action overall was extremely, it was in an extreme downtrend, and there was no short interest to corroborate this. There wasn't any indication that shorting was going on, but nevertheless, the stock looked as though it was being shorted, and it was really extreme in the amount of downward price action that we saw during this time. So I'm going to show you exactly what it was that was going on in MULN. This is a chart or a table from our ScourgeBot tool that we built at Hell's Trading Floor. And what this table does is it shows us the price action versus the FINRA short data as well as FTDs, and it does a little bit of analysis on some of that price action. So way back in the early days, back in February, we're going to look at these dates here before the 1st of March. What you have are the open, high, low, and closing prices, and then you have the volume, and short exempt volume columns. And then finally you have short exempt ratio, which is just simply short exempts divided by short volume. Multiply that by 100 and you get the ratio. So it's basically the percentage of short volume that is short exempt. This is what was going on in MULN's chart at the time. Starting on February 15th, the short exempts started to climb rapidly along with short volume. Now the short volume overall was getting pretty large, but the short interest that was estimated on Ortex wasn't climbing quite as quickly. It was the short exempts that really got my attention at that time. And it was because of these numbers, these extreme numbers. At this time, MULN's float was extremely small. It was something like 20 million shares in total. And at one time on this particular day, on March 1st, MULN's entire float was traded as short exempt. This massive extremity is what really tipped me off, and it sent me into a fiery rage over the entire incident because I knew that this meant that there was fraud going on. Now, what is short exempt? I've explained this many times on my channel. There's a video that's available elsewhere that I will link at the end of this video so that you can get a full description of what short exempt is. But basically, short exempt is a short that is exempted from the locate and the SSR rules. Only market makers are allowed to do this. They use it in order to supply a liquid market, and they're legally permitted to do it. But what you may not know is that short exempts, if they are not located, meaning that if the market maker decides we need to take a short exempt because this is an extreme situation, we are not able to locate a share at this time, then that is a naked short. It is supposed to be a temporary measure, and the market maker has 4 days from the day that they make that trade, that's T plus 4, to locate that share. If it doesn't occur by that time, it becomes a failure to deliver. And after T plus 2, after that date, then the market maker is required to deliver the share. Failures to deliver can be recycled by market makers. They can do all kinds of crazy things like using options, recycling shorts, and taking out shares on loan. They can also cover it with borrowed stock. But all of these things that took place on MULN is what showed that a massive move was coming. This was probably the most extreme example, and that's why I'm showing you this play first, because it was the clearest image of when massive fraud was taking place. So from that time when MULN had hit a peak at $1 after selling off down to something like 52 cents at the low, the price consolidated a little bit more, but after T plus 6, the price spiked all the way back up to $1 and kept going. And it kept going so much so that it eventually reached a peak of $4.17 on the 21st of March. And then it tapered down from there. Where things went wrong is that MULN had a huge options chain that opened up, and it had already been in existence at the time. The problem is that retail loves options. They especially love cheap options, deep out of the money calls that really make no sense. And it's a bad way to trade. Options, I do believe, can be extremely profitable, but it is not how you squeeze a stock, and choosing an option just because it is cheap is an extremely naive way to select an option, especially call options. But we'll get to that in a minute. As we go on further on throughout the price action history, we see that MULN sold off to its latest lows sub $1, and then we started to see massive short volume kick in as the price began to rise again. Notice that the short exempts are also beginning to rise. We've been seeing short exempt ratio spiking again, and we most recently, just the day before yesterday, had a high of 6.89% short exempt ratio. These massive jumps, which we mark out by showing the delta here in these two columns, show the differences between the short exempt on the previous day and the day before. These spikes help to tip us off when these events are going on, and we use these signals every day at Hell's Trading Floor in order to figure out whenever a market maker is abusing their power and they are using it in order to get a levered position against a stock. Market makers are not supposed to do this. It's extremely illegal because they're actually going against their charter as a market maker to provide a liquid market, and they're taking directional plays against stocks because they know that they have the power to do it. It's in situations where retail takes control, flips the exchange algorithms, and is able to send the stock going in the other direction that market makers get into trouble. And that's exactly what happened with MULN. They got control of it again, but market makers are losing control all over the market, and it's happening repeatedly. Let's continue. So here we're just going to watch MULN play out during this entire time where the short interest was spiking at its highest. And you finally see that on the 1st of March was when the most extreme example, this right here, was the most extreme example of short exempts. This was market makers hammering the price down and getting control of it again. Here is where they went wrong. Retail started getting wind of this stock shortly after I had called it out, and I basically threw my name out there and pointed out that all of this fraud that was going on in the stock and how it was happening between short exempts and a massive amount of failures to deliver began to signal that market makers were losing control, and that if retail started buying up the stock in massive amounts, that it would be possible to actually throw it back in their face and cause massive losses. I did this on the morning of March 2nd because I was able to demonstrate just how absurd the short exempts from the previous day had been. T plus 6 days later, 1, 2, 3, 4, 5, 6, we see the price had hit its lowest point, and the day after, this morning, was when failures to deliver were meant to be delivered. Market makers were put into a position because they had not been able to get the price back down below this level, where they had to cover all the failures to deliver that had been created up until this point. Once the price started going against them, it put all of these short exempts that they had not located into failure to deliver status, and from that point, they had totally lost control. Where they regained control is at this point where the options chain was blown out and retail was convinced to start buying deep out of the money options at ridiculous prices. We're talking like $6, $8, $10. And all of that liquidity that was pumped into the options market gave market makers additional control. They were able to buy deep in the money options down at sub $1, which those are essentially just a way for them to collect shares. They buy those deep in the money options that are at a delta of 0.98 or higher, as close to 1 as possible. If you're not familiar with the options Greeks, delta just means the value of the options premium relative to the value of the underlying stock. The closer it is to 1, the closer the premium's intrinsic value is to or the closer the intrinsic value of the option is to the underlying stock. And when you have a delta of 1 and all the other options Greek values are extremely low, it causes the call option to be worth almost exactly the value of the underlying stock at its current market price. So if you want to buy a $1 call option and it's trading at $4, if the delta is 1, then buying a $1 call is almost the same as buying the stock itself, 100 shares of the stock at $4 plus a couple cents. And what this allows the market makers to do is they collect a whole bunch of deep in the money call options that they're able to exercise for the exact amount of money they paid in premium. The cost to exercise is no different from purchasing the stock. Therefore, they can exercise all those calls and collect shares without affecting the price. And this is how they get us. When they start buying those deep in the money call options, it's a signal that they're starting to accumulate to prepare for a rug pull. And that's when retail needs to start paying attention, because 1, it means that the price will start traveling up, but it also means that the market makers are trying to get ahead of it and get enough shares so that they can rip the rug out from underneath us. And in the meanwhile, they're going to start collecting premium for deep out of the money call options, trying to convince retail to keep buying those stupid deep out the money calls. Retail needs to stop doing this, because when these prices run, although those calls are extremely enticing, they're extremely, extremely dangerous. Purchasing shares is really the only way to make those safe moves, and then covering yourself with protective puts in case of that rug pull is the only way that retail can smartly protect itself. Buying those deep out of the money calls is only going to provide liquidity to the market maker, which they use to buy those deep in the money calls, get more shares, prepare to pull the rug. And they can sell these calls naked. And if they get enough of them in huge numbers, then it will only result in retail hurting itself. So this is how we win. I'm going to introduce Redbox to you, which you've probably seen many, many times. This was originally a play that was called out by Cadud to me, who later on he flipped in and out of the stock, and I've been watching this one very carefully. There's been a lot of the same situation that there was with MULN going on with Redbox, where short exempts became very extreme, especially on days like the 11th of May. So let's go over to that short exempt data and let's illustrate that. Redbox's short exempt data. Like I said, massive downward price action. Look at the short exempts. Absolutely enormous. It was 839.5 thousand short exempts. That's just less than 4% of the total short volume that was traded that day. And they were able to drop the price from its high, from its yesterday's high, or actually the daily high of $6.12, all the way down to a low of $2.80. It closed at $3.20. Now, those short exempts almost certainly failed to deliver. It's extremely unlikely that those were successfully located, because the market maker, in order to get liquidity, drive the price down, get more shares, they needed to make sure that they were sending the price down so that they could start buying those deep in the money calls. So they used those short exempts to drive the price down rapidly. They basically shut off all retail orders going to the exchanges, and they route them to an internalizer. That's what the short exempts allow them time to do. It gives them basically a 6-day delay on needing to deliver those shares. So they use it as a temporary measure to collect all the retail orders, route them internally, and then they go and make a giant order inside of dark pools in order to get those shares and then deliver those orders later. Typically what they do it with borrowing. And this is where we get into another signal that I'll show you here on Ortex. So this is Ortex's data. This is the default view in Ortex when you open it up. There's only a few things that you need to do. You can turn off days to cover, you can turn off the exchange reported short interest percent of free float, and you can turn off the estimate. What I want you to do is open up the on loan, open up the estimated short interest, and open up security lending volume. When you look at this, there's only a few things that you're looking for. The main events that you're looking for center around early March, where you see the short interest was increasing at a rather slow pace, with on loan slightly below it. During a time when there was a massive amount of short exempts, the on loan jumped shortly thereafter. Under the advanced view, go ahead and add FINRA short exempt volume, take away the security lending volume, and you'll see exactly what I'm talking about. Here on this day, we had a massive amount of short exempts as well as a giant jump in the price action. 2 days later, the shares on loan spiked massively. After another day of massive short exempts, the price came back down. And then they got it back under control. Now here's where they lost control and Redbox started to go viral. As soon as the short exempts started to climb rapidly and they did not get control of the price, the number of shares on loan rapidly ascended far, far beyond what the actual short interest was. This is market maker activity. When you see these short exempts spiking and you see the on loan lagging behind and rapidly moving up ahead of short interest, that tells you that a market maker is filling retail orders, levering up their books, accumulating more and more short exempts, more and more failures to deliver. And this is the situation that they have gotten themselves into. The on loan is at a massive level. The price is still moving against them, and they're still struggling to keep it under control. Right now, the short interest of free float is 225%. The free float on loan is 178%. They're slowly preparing to drive the price down. They've actually been in this process for some time. Now they've gotten the on loan back underneath the short interest, but short exempts are continuously spiking. The way that retail can hurt market makers is to continue buying and holding shares. This is how it works. The market maker is trying to entice us to buy deep out of the money calls on days where they allow the price to run with these huge candles spiking up to like $17, $18. When you buy calls on those days and you buy them for out the money because they're cheap, They use that premium to exercise all of their in-the-money calls and drive the price down. They exercise the deep in the monies. They slam the price down by selling those all at market, and then they scoop up more deep in the money calls once they get the price down to a level that's acceptable to them. And they repeat this process until they've accumulated enough shares to cover their position. How retail can retaliate is by marking out the levels of price action where they see these price drops happening. And when they hit this level, like $9, this area of significant support, that is what retail can do to continue to hold support up while the market maker is trying to drive price down. How can you spot that support level? Very simply, you use charts. There's a few areas and a few tools that you can use with TradingView, for example, that will show you these areas of support. I like to use moving averages, and I like to use fixed range volume profiles, which you can find here. These fixed range volume profiles will show you a volume shelf, which you can use to mark out areas where there was significant buying and selling. The buying is in green, selling is in orange, and at specific price areas, such as right here, you see between $10 and $10.50, the price is consolidating significantly, and buying and selling is almost perfectly evenly matched. Market makers are desperately trying to drive this below this level and get it below its 200 period moving average on the hourly chart. That's what this red curve is. So this bounce here off of the 200 is a significant price level. This is the point where retail can start to hurt the market maker by buying up all the shares that it possibly can. Stay away from those deep out of the money calls. It's too dangerous. And you're only providing liquidity to a market maker by doing so. Although it is possible to profit off of it, on the whole, retail needs to be buying shares in order for this process to work. Market makers are in this situation because they are abusing their power, they're abusing their position, and they are taking these positions in order to fleece retail investors. And that is why I have no qualms about using these tactics against market makers. And this is why I want everybody to understand how this works. The more people that understand this and understand how this process is used against us, the more prepared we can be and the more likely we are to profit from their stupidity. At the moment, Redbox is bouncing off of a significant price level, $9. The next major significant price level is $8 and $7.50. These areas are massive, massive areas of support. Keep in mind, Redbox itself is a very risky play because there is a known acquisition that is being prepared. It is likely to drop the price of Redbox back down to sub $1. It's very possible to take a massive loss on this. So I want everybody who is paying attention to this video and thinking that this is going to be their next $1 million idea to slow your roll and look at this very carefully and remind yourself that this can fall all the way back down here. So what do you do about this? Hedge yourself with puts. Prepare yourself by buying yourself protection. Whatever you decide to buy in shares, make sure you are protecting yourself with puts. Guarantee yourself a plausible exit. Guarantee yourself that route out if they pull the rug out from underneath you. That is what options are meant to do. It's meant to hedge against that volatility. It's for protection. So if you're buying shares, buy an appropriately equal amount of puts to protect yourself. Don't put yourself in this situation where you're buying all of this stuff with money you cannot afford to lose and then kicking yourself, losing all of your money, and then throwing all the knowledge you've learned through this video and all the time you spent in the stock market away just because you took a huge loss. Please protect yourselves. This is a very risky play, and I want everybody to make it out intact, not just intact, but in profit. So now that we've covered all of that, the last thing that I want to do is point out a few other signs that we can look at on Redbox, MULN, and one other stock, GMVD, which are all exhibiting these same symptoms. So first, we're going to cover Redbox. Get really close into the chart. We're going to take a look at a few last stats. First, we need to take note the failures to deliver are rapidly moving up. Market makers had a really, really bad week. All of these failures to deliver are likely in progress of being delivered, and that is part of what this move down has been. So there is incentive for them to drive the price down on RDBX. As I'm recording this, I'm watching the price of Redbox hover at around $10.93. So at the moment, we've got a few items to take a look at. Redbox had a huge amount of short exempt volume on a day that it traded at a high of $14.69. A lot of this short exempt volume was likely in order to defer all of this volume and the price action so that market makers would be able to defer delivery on those shares until a later time when they could cover them at a lower price. Right now, the price is hovering at $10.93. In order to put market makers in a back up against the wall, enough shares need to be bought in Redbox in order to drive the price back above $18, ideally, just because it would put all of these back, it would put all of these short exempts into failure to deliver status, and the market maker would have to start making a decision of how many calls they're going to have to buy in order to cover those as well. But the real price target is going to be at $14.70. That price or higher would actually put everything that the market makers have created for the last 6 days into failure to deliver status. They tried to drive it back down below $9 because it was this level where they would be able to deliver all of these previous short exempts. Right now, the price is holding itself up, which is fantastic. But don't be fooled. There's still a pretty serious likelihood that market makers will be able to drive this price further down. There's inherent risk in this. Redbox has already made significant moves, and even though there are plenty of retailers that believe that this can be done, there are just as many, if not more, retailers that are day trading this and don't believe that this type of squeeze is feasible or even worth their time or the risk. So understand this, and this is why I say make sure that you're hedging yourself with puts and you're not over leveraging yourself to the point where you're taking on more risk than you're willing to tolerate, that you couldn't survive if you lost everything. With Redbox, the on loan is starting to trickle back up again. Utilization is still maxed out just like it's been for the last several months. Cost to borrow is insanely high at an average of 1,000 points. It's just insane. But anyway, the last thing to note is that we are still on the threshold list at this time. If at any point Redbox comes off the threshold list, which gets reported at roughly 8:30 p.m. Eastern Standard Time every single day, if it doesn't end up on the threshold list by the following day, then Redbox is in trouble. This stock being on the threshold list is what is keeping market makers up against the wall. If at any point they're able to cover enough failures to deliver to get this off of the threshold list, then the momentum will be against us. As it currently stands, market makers are at the mercy of retail. But in order for us to, I guess, deliver the coup de grace, will require that same buy-hold mentality in the face of all of this selling pressure that is going on right now. It's getting scary, and I still want people to hedge themselves and set themselves up with a cushion in case something goes wrong. But at this point, we bounced off of a significant area of support. Redbox is holding itself up nicely, and there is room to run, but it is going to take a determined and concerted effort by retail. This is absolutely not financial advice. What I am describing to you is an extremely risky proposition. Please don't do this with money you're not willing to lose. I cannot emphasize this enough. Next, we're going to look at MULN, because MULN is starting to do the same exact thing. Let me take away all of the replay stuff and we'll get up to speed with the latest price action. So, MULN, on its entire chart since the beginning, this is an hourly time frame with after-hour sessions included. I have several indicators. The on-balance volume, a stochastic moving indicator to show, it's called the STC. This is basically just a momentum indicator. And I have the RD moving average, the moving average RSI divergence indicator. As well, I have a smooth moving average. So, there are several moves that are beginning to mirror themselves in MULN. So, MULN had this long selling channel all the way down to a price of 60 cents. And at that point, it created this inverted head and shoulders before it made its first impulsive move and then crashed back down with a high amount of short exempts happening on the 1st of March. It then retraced back to a price level of 75 cents. This is a significant price level. After that point, it legged up, impulse move, retrace, impulse, retrace, impulse, retrace, impulse, retrace, and impulse all the way up to $4. In total, all of these impulse moves from this point forward accounted for a move about 450%. That's huge. What I want to point out is that there is the same setup pattern happening here. There's an inverse head and shoulders showing up here on the 9th of May, and it completed its formation on the 16th of May before it failed and broke down. And it consolidated sideways. We then later on had this big impulse move, which is very similar to the impulse move that we saw here on the 28th of March and 1st of March. 28th of February, 1st of March. So if these are similar impulse moves following an inverse head and shoulders pattern, it's possible that we're seeing the same we're seeing the same bottom form here as we did earlier back in March. What I'm getting at is that these are repeating patterns that, while they don't look identical, are very similar in their structure, and they're similar in their volume spikes. This is a little bit more drawn out, likely changed by algorithms just to avoid tipping off anybody else. But what I'm seeing is there's big support for MULN at $1, and after it bounced off of this level, which is only 25 cents above this previous level where it had a huge impulse move, what I'm thinking is about to happen is MULN is going to start receiving a bit of volatility. Keep in mind that there were more catalysts surrounding these moves. MULN is also discussing there's talk of investigations and litigation against MULN, so there's a lot of FUD. There's a lot of bearish talk against MULN. It's important to keep these things in mind, because even if you don't subscribe to it, recognize that there are many traders out there who will, and that momentum can work against you. I am, just full disclosure, in a MULN position. I have extended out my position in MULN for at the money calls and a very small block of shares that I will be holding. The calls expire in July. For the Ortex data, we have continuously rising short interest. We have on-loan shares on loan outpacing the short interest, and we have spikes in short exempt volume. So here's MULN's short exempt data, and yes, this is the latest up-to-date data. For whatever reason, FINRA data for short exempts and short volume didn't report last night for MULN. I don't know what's up with that. We'll work it out. But in any case, we currently have massive spikes in short exempt volume going back all the way to the 31st of May. And recently, on the 13th of June, we had a huge spike in short exempt volume that amounted to 6.9% of the total shorts out for the day. The short volume versus total volume is still at its lowest point. So there is significant weakness here for the bears. This is part of my confluences for confirming a trade before I enter it for a reversal. I see weakness in the shorts and I see massive short exempts while market makers are trying to suppress buying volume. I think that at this point it is very possible MULN could start to see some pretty significant moves in the near term, and there are some bullish catalysts with their new talk of a deal. The CEO has been hyping it a little bit, I'll say. We don't know what this deal is supposed to be, but they are promising that it's going to be significant for shareholders. So I'm at least inclined to believe that it will be good for the company. It remains yet to be seen if it'll be good for shareholders, but I'll give him a chance to surprise me. The thing that I would encourage everybody to watch is continue watching short exempt data and the climb of on-loan data for MULN. If on-loan shares continue climbing as they have been, then the short interest will follow suit. It's just going to take time. The short interest of free float is a lagging indicator compared to the on-loan, and when you see how fast the short exempts continuously climb up, this is how we track it. Short exempts become on loan, become failure to deliver, and that becomes short interest. But the short interest of free float is lagging behind it by several days. I have noticed this consistently across all of these major squeeze plays, all of these plays where the market makers are playing games. There's consistent patterns here. So everybody, please keep paying attention to this. Just know that the utilization being maxed out, the on-loan climbing while short exempts are spiking higher and higher is a sign of momentum and volatility coming into the stock. This one you can't really hedge for with puts, but there's limited downside with it already being close to $1. For me, that's a acceptable risk. And then finally, I'm going to get to G Medical. G Medical is a stock that was called out by Hoot Money, and he asked me to take a look at it. And interestingly enough, it shares many similarities with MULN and Redbox and SPRT, and all those consistencies have helped me to decide that it's time to enter into a position. So let's cover this one. Short exempts on GMVD are absolutely off the wall insane. If you look at the recent price action compared to its volume, which has been in decline, the price has continuously gone down before it had a huge gap down and, it gapped up and then closed at its lowest price yet. And this was a day of significant short exempt volume. Looking at the short exempts, you can see that on the 13th and the 10th, GMVD closed at, let's just cover the 10th for now. GMVD was on decline, and then it had a massive spike to the downside after it had hit a high of 75 cents. As I understand it, Hoot Money was already in the play at this time, so this was absolutely a rug pull. The price got yanked all the way down, and it's absolutely because market makers did this. They shut off retail orders going to the exchanges, and they took all of their volume away from the exchange to hurt price discovery. These short exempts are likely not located. It's possible that it's been located, but it's also possible that the market maker has yet to locate the shares. They haven't determined where they can get those from. And the price is immediately moved back up to its previous location at 64, 65 cents the day after. So these short exempts, if they have not been located, are already in danger of becoming failures to deliver. So this is a point where retail can actually make a concerted effort to hurt the market maker and hurt institutions that are naked shorting the stock. Currently, GMVD's CEO and executive staff, their board, are investigating naked shorting on their company. So they have vowed to pursue, to the best of their abilities, legal action against any responsible parties for naked shorting their company. It's important to note that this is a novel research company in biomedical. They only recently IPO'd, and they've been absolutely slammed in the exchanges. Interestingly enough, they are throwing multiple confluences with bull flags repeating themselves, which is the same thing MULN was doing all the way down to its lowest price. GMVD already hit a low of 38 cents, which to me that is, 32 cents. To me, that is an acceptable risk to take on a stock like this. If you're betting on penny stocks, just know that the rug can get pulled even lower than that. The other thing that you have working for your favor is bullish divergence on the OBV, which shows that the price is moving higher despite this descending price action. High likelihood for a big reversal. You have bullish divergence on the RSI. It is in oversold territory. And you have a micro float basically with less than 60 million shares. And it was said by the CEO in an interview with Hoot Money that the actual float is significantly lower than what is stated by the exchanges. So all of these are excellent confluences to demonstrate that this is a stock that could make a huge move to the upside. I'm not going to say squeeze yet, but it can make a large move to the upside, given that, one, this stock does not have an options chain. This is the same condition that Redbox had before the options chain came out. Redbox was able to move more than 400% from sub $1 all the way up to the $3.20 range, I believe it was at the high point. So GMVD can do that same thing. MULN had a very small options chain at the time because it was trading so far below $1 at the time that nobody wanted to touch their call options. All of these conditions all of these stocks have this commonality between them that the more liquid and the more heavily traded their options are, the more market makers can screw with it. So that's the thing that I would leave you with to caution you against jumping in to options. Don't trade solely options on these stocks. Market makers have too much control if retail just goes all in on call options, because calls don't move the price. Calls provide liquidity to the institutions who will move the price for you, and they're not going to let you assign them their calls. Purchasing shares is what flips algorithms, and this is the last piece of the puzzle that I want to help people to understand. The exchanges themselves work by detecting and determining what type of volume and what direction the volume is going based on time and sales and the amount of orders that are coming in. And there is a technique known as hammering, or single order hammering, or single share hammering, that is done by institutions that figured out that the exchanges will flip their algorithms based on the number of orders that are flying into their order book. So I'll explain this. Every once in a while, if you're not paying close attention to the level 2 order book, you can easily miss this. But there are situations where in time and sales, especially in after hours, where you will see a flurry of single share buying or selling orders which are being sent by an institution. These institutions, what they are trying to do is sending all of these orders directly to an exchange with the intent to flip their algorithm. The algorithm determines the number of orders, and it is those number of orders rather than the number of shares that has the desired effect of flipping the algorithm into the desired direction. By sending those flurry of single share buy orders, the algorithm determines that there is more sentiment, more interest in a stock, and therefore the algorithm decides, oh, I just received 1,000 orders for a single share apiece of stock XYZ, I should go and buy a block of shares in order to provide those to the customer. So the algorithm makes that decision autonomously, and it starts buying shares, and naturally the price begins to lift. This effect can be spoofed in a way by institutions who have figured this out, and they started hammering the price at the exchanges by sending single share orders in massive numbers. And this works because of automated trading systems. The thing is that retail has a similar effect in that retail sentiment, which is this is how it is supposed to work. The algorithm determines genuine interest in a stock, so they see a large amount of small orders as a sign that many buyers are interested in a stock. That's what genuine retail interest looks like. So in those situations where you have hundreds, thousands, even tens of thousands of retail shareholders purchasing shares in small amounts of a particular stock, this can have the effect of causing the exchange algorithms to go long on the stock. So I'll let that sit with you for a little bit. Again, this is mostly speculative theory. This can't exactly be proven without firsthand knowledge of how the exchange algorithms work. Most of the evidence that I have to corroborate this is purely anecdotal. So I've only been told this from secondhand people who claim to know people at the exchanges or claim to know the people on Wall Street that have figured this out. So it's not guaranteed, and there's no way for me to actually prove this, but I have back tested this on multiple stocks. I've seen this happen on indices such as the SPY. I've seen it on I back tested this on several of the stocks that we have played, and the movement after hours seems to be consistent with whatever the stock is going to do the following day, wherever you see those hammer orders of single share orders. So it's worth paying attention to, and I would challenge other retailers to continue to do research on this because it's an interesting idea, it's an interesting concept, and it likely does have a pang of truth to it, even if it's not entirely true, that sending a flurry of orders to the right places can absolutely have an effect on stock prices in the near term. So I've covered a lot of concepts between market maker mechanics, exchange algorithms, and trading mechanics. The last thing that I will point out to you is just we'll go over one last time the GMVD data, which is showing currently that there's a very small amount of short interest. So if you haven't believed what I have said so far, if you still are in doubt and you want to see this play out in real time, I'm calling this out right now on GMVD. GMVD has almost no failures to deliver in its history. It is not on the threshold list. The security lending volume is oddly pretty choppy. So, what I am predicting is going to happen. Utilization has recently just met its maximum point. The on-loan shares is starting to rise rapidly. What I anticipate happening is that because we have seen a massive amount of short exempts, which I can show you here, the short exempt volume is spiking massively here. In 4 to 6 trading days, the on-loan shares will spike immensely just based on a little bit of rough math. I'm predicting that within a trading week, short interest of free float on GMVD is going to move up by at least 8%. You will see this stock trading at a short interest of free float greater than 10% by the end of next Friday. So if my theory is total bullshit, then expect this number not to change at all. But pay attention if you start to see the price moving up and you see the short interest start to spike. And with that, I will leave you to do your own research. As always, nothing that I say here on this channel is financial advice. I'm not a financial advisor nor an expert in matters of finance or stock market mechanics. I am just an amateur day trader, but I am hoping that together we can learn and figure this shit out in order to make market makers and fraudulent institutions and hedge funds pay for what they've done to us, fleecing us, and through collective knowledge, we'll be able to win. Thank you so much for watching, and I look forward to seeing you in the next video. In the meantime, have a hell of a time in the markets.